bonds issued at face amount, which we also call par. And that's when the contract rate equals the market rate. So all of the information is given to us in the problem. We really don't have to do any additional calculations. So when bonds are issued at face amount or par, like I said, the contract rate equals the market rate. Remember, the contract rate is the rate that the company is offering with the bond issuance. So that is the amount listed in the bond indenture. That cannot change. Contract rate is what it is, and that is the rate of interest that is paid to bondholders in regular increments. The market rate can sometimes be different than the contract rate, and that is based on overall within the bond market, what other bonds might be selling for or what rate of interest they might be offering. But in this case, when we talk about bonds issued at face amount or par, both of those rates are the same. So the bonds sell at their face amount. So if it's $1,000 bond, it sells for $1,000. And we quote that at 100 because the bond is selling for 100% of its face amount, no more, no less. So when bonds are issued at face amount, these are the journal entries that you'll be looking at. So first, for issuance, remember, a bond is a liability, just like any other liability or loan. And the way that that's recorded is a debit to cash because the company is increasing its cash with this bond issuance, and a credit to bonds payable to record the liability. And this is done at the face amount. So if it's $1,000 bond, you would debit cash for $1,000 and credit bonds payable for $1,000. As simple as that. Then for the regular interest payments, you just record interest as you would with anything else, any other expense. So a debit to interest expense and a credit to cash. And you will calculate the interest expense based on the face value of the bond. So for example, face value is $1,000, and you would multiply that times the contract rate. And that's how you get either the annual interest amount, or if it's every 6 months, whatever increments those are in the bond indenture. Then when the bond matures, remember, the company does not have to repay any principal amount to the lenders, to the bondholders, any principal until the bond matures. So if you're thinking about other loans, for example, think about the way that your car loan works. As you repay the money that you loaned, as you're making your payments, you're paying both principal and interest. That's how bonds are different though, because incrementally the company only has to pay interest. Then when the bonds mature at the end of the life of the bond, that is when the face amount is repaid. So the interest rate will be calculated based on this. The repayment at maturity will be based on the face amount, which again, for my quick example, was $1,000. So those are the very basic journal entries for when bonds are issued at face amount. So I just went over this, and now I'll go over it in a little bit more detail just to give you an idea of what we're debiting and what we're crediting. And remember, this is at par value or at face value. So the cash received will be the same as what is on the bond itself. So if it's $1,000 bond and a 7% interest rate, that is what it will be. There's no difference here when the contract rate equals the market rate. So that would be a debit to cash of $1,000 because the corporation is increasing its cash with that money that was invested by the bondholder. And then to record the liability of the $1,000 to be repaid at maturity. The interest payments. The interest payments are calculated again based on the contract rate on the bond. So we have our $1,000 bond at 7% interest when the market rate and the contract rate are the same. So the 7% that's on the contract, that's on the bond, when that matches other similar bonds in the market, then that's when we have the face amount remains obviously $1,000. That is what's paid for the bond, and the contract rate and the market rate are the same. So regardless, if we're looking at other examples, obviously this is the easiest one to calculate, but if we're looking at other examples where maybe a bondholder pays additional when, for the bond issuance, if they pay more up front, well, that means that the rates are going to differ. But here, and regardless, when you calculate the interest payments for any scenario, you always use the contract rate that is on the bond. So I have the basic calculation here to help you figure out how to calculate the interest. So the face, 1,000 times the contract rate, which is 7% or 0.07. But you also have to take into consideration the time period. So you probably learned this in like high school math or whatever. Principal times rate times time. That's how you calculate interest. And so that's the same thing that's basically going on here. So if it was an annual interest rate, if it was an annual term for the interest to be paid, then you would just use this to calculate interest annually. But not all interest is paid annually on bonds, and that just has to do with what the corporation, how they want to put that bond issuance out there. So they might, instead of having annual interest payments, they might make interest payments semi-annually or every 6 months. So if that's the case, then for the time period, you would put 6 months over 12 months, and that's just a way to prorate it. So that's how you would calculate the interest expense. And then the journal entry, just like with any other expense, will be a debit to interest expense. I think your book technically calls this bond interest expense, just to be a little more specific. And then obviously a credit to cash because the company's cash is decreasing as they are paying the cash to their bondholders. Then repayment at maturity. This is just like when you reduce any other liability on the books by paying cash. So at the maturity date, that's the end of the term of the bond. So if it's a 5-year bond, then it will be at the end of 5 years. The business must repay the investor the face value of the bond. So if it's $1,000 bond, you would debit bonds payable for $1,000 and credit cash $1,000. So here's an example. And this is the full example on this slide, and then I'll go through each of the individual journal entries on the next slides. So this is an example of bonds issued at face value or par. Brussels Enterprises issues bonds at par dated January 1st, 2021 that have a $2.8 million par value, mature in 4 years, and pay 9% interest semi-annually on June 30th and December 31st. So I like to go through and underline the things that I know are important. All right, and so the 3 journal entries that we'll have to do for this example are the issuance, the first semi-annual interest payment, and then the second semi-annual interest payment, and then finally record the entry for the maturity of the bonds. So those are the 3 different journal entries that we'll be looking at. So as a reminder, here is the information for the problem, and we're just going to look at these one at a time. So here we're going to be recording the entry for the issuance of bonds for cash on January 1st. So if we want to set up the information so that we have a visual of what's going on before we do our actual journal entry. If we say we have a bond and the face amount is 2.8 million and it has a contract rate of 9%, matures in 4 years, so it has a 4-year term. We know that this is at par, so the contract rate equals the market rate. The interest rate is semi-annual, so 9% semi-annually. All right, and if we want to go ahead and set up our journal entry, so this is for January 1st, 2021. The basic journal entry is going to be a debit to cash because the company is increasing their cash because a bondholder is lending essentially the money to the company. And since money is being lent to the company, that is a liability for the company. So a liability has to be credited. When it's a bond, you credit bonds payable. Since this is at face value or par, the amount that's recorded is the face value of the bond, which is the 2.8 million. So that's the issuance. Then for the interest payments, so we are going to look just specifically at 2 interest payments. Remember, interest payments happen in regular intervals throughout the term of the bond, but we're not going to go through every single interest payment journal entry. We're just going to do the first 2 to make sure you know how to calculate the interest correctly. So the important information, the $2.8 million par value or face amount. It's a 4-year bond, 9% interest, but what's very important is the semi-annually. And those are going to be on June 30th and December 31st of 2021. So record the entry for the first semi-annual interest payment, which is on June 30th, and the second semi-annual interest payment. So if we're recording interest payment, obviously we have to calculate the interest first. So remember that's going to be the face amount, times the annual interest rate, times the time period. So the face amount is 2.8 million times the annual interest rate of 9%, but that is an annual rate. That is not the rate for every 6 months or semi-annually, like when the interest is paid. So we have to prorate that for only half of the year, or only 6 months out of the year. So we multiply that by 6/12. When we do that calculation, it comes out to 126,000. So that is the amount of interest that will be paid out every 6 months in this example. So we will record June 30th and December 31st. So June 30th, the journal entry for interest payments is a debit to bond interest expense. Because we're recording an expense just like any other expense. And in this case, since the contract rate equals the market rate, then we will be paying in cash bond interest expense of $126, and cash is how we're paying that, so credit cash $126,000. Now for the next, so this one was June 30th, for December 31st, it will be the exact same journal entry. For this bond, the exact same journal entry will be made. for each of those interest payment. So instead of me writing that all out again, just know that for each semi-annual interest payment, it will be this same journal entry. So then finally, this will be the journal entry for the maturity of the bonds, and that will be December 31st, 2024. And we're going to assume the semi-annual interest is already recorded. So just know that this was a 4-year bond. So remember, every 6 months that interest is paid. Well, the very last interest payment would also technically take place on December 31st, but we are going to assume that that has already been recorded, and we're only going to worry about the actual maturity journal entry. That's when the principal or the face amount is paid back to the bondholder. So since the contract rate and the market rate are the same, the face value is what was paid. But at maturity, that doesn't necessarily matter, because when you are looking at the bond repayment and the interest calculation, you always look at the actual bond itself. So if we're looking at our bond and the face value was $2.8 million and the contract rate was 9%, those are the things that matter when it comes to the interest calculation in terms of the cash that is paid in relation to the interest. And then the face amount is what is repaid at maturity no matter what. So on December 31st, 2024, the journal entry to repay the principal to the bondholder is a debit to bonds payable to reduce the liability, and a credit to cash because the company is paying the cash back to the bondholder, and that is for the face amount of $2.8 million.